tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Welcome to the Power of Zero show. This is your host, David McKnight, best-selling author of The Power of Zero, Look Before You Lerp, The Volatility Shield, Tax-Free Income for Life, and the soon-to-be released The Infinity Code. It's a full-length, 75,000-word novel in the Dan Brown mold. It's a suspense thriller within which is couched a financial principle that has very real repercussions for our nation. Be looking for that in fine bookstores near you in the next couple of months. If you're looking for someone to help you navigate all of the pitfalls that stand between you and the 0% tax bracket, head over to davidmcknight.com. I'd be happy to connect you with a member of our elite POZ advisor group. Among the very best tax-free retirement plan specialists in the nation, they're trained, vetted, qualified personally by me. If you are a financial advisor and you're looking to level up your game and adopt Power Zero principles into your financial planning practice, then head over to powerzero.com, opt into our free 3-part video series. At any point during that series, you can set up a phone call to chat with our team. If you're looking to buy any of my books in bulk, you can do so at davidmcknightbooks.com, where you can mix and match titles to achieve bulk discounts. If you're just looking for a single copy, best to do that over at amazon.com. Would always appreciate a follow on Twitter. It's at McKnight & Co., at McKnight & Co., or on Instagram, David C. McKnight. That's David C. McKnight. Would also love a subscribe on my YouTube channel, which is aptly named David McKnight. It's David McKnight. Subscribe today, and you'll get all of my podcasts and a lot of other little short videos that address various topics. Check in on it and give us a subscribe. Would love to have you along for the ride. Today, we're going to talk about the difference between your effective and marginal tax rate and which one is relevant in different financial planning contexts. Now, it's absolutely critical that you get it right, because if you don't, then you're not going to be doing an apples to apples comparison when deciding on whether a given financial decision makes good financial sense for you. Now, as groundwork, I'm going to revive an analogy that I've used in the past, and that's of the graduated cylinder. Now, if you think back to chemistry class, there was that long, skinny cylinder with the red lines on it. No, not a thermometer. Call that a graduated cylinder. Well, our tax system in our country works exactly like a graduated cylinder. Your money flows in, flows all the way down to the bottom. Some of your money gets taxed at 10, some at 12, some at 22, some at 24, some at 32, some at 35, and finally some at 37% if you have that much income. So to put it into perspective for you, even Bill Gates has some of his earned income taxed at only 10%, if for only about 3 seconds, right? And then he moves rapidly to the top, and most of his income actually gets taxed at 37%. So generally speaking, when you earn income or experience income by, for example, taking a distribution from an IRA or a pension, well, that income is going to flow into that graduated cylinder. And as that cylinder fills up, you pay different tax rates on different portions of that income. All right, now that we've helped you visualize how our U.S. tax system works, let's define marginal tax rates and effective tax rates and see if we can sort of tease out the difference. Once we do that, we can lay out the financial scenarios in which we would use those various tax rates. All right, first let's begin with the marginal tax rate. This is the rate at which you pay tax on the last dollar in your tax cylinder. So for example, if your taxable income is $100,000, then that would put you in the 22% marginal tax rate. In other words, that last dollar is going to be taxed at the 22% rate, which means your highest marginal rate is the 22%. All right, effective tax rate. This is your tax as a percentage of your taxable income. To figure it out, you have to follow a formula. It's pretty easy. You take your total tax and divide that into your total taxable income. So for example, if your total federal tax is $15,000 and your total taxable income is $100,000, then your effective federal tax rate is going to be 15%. The effective tax rate is always going to be lower than your marginal tax rate. All right. Let's talk about when you might use your marginal tax rate. There's a couple of different scenarios where it comes into play. First one is, and this is probably the most common one that we utilize in Power of Zero Plan. That's when we are executing a Roth conversion. If you're going to do a Roth conversion, it's eminently helpful to know what your marginal tax bracket is. Why? Because this will generally be the rate at which you pay taxes on that Roth conversion. So here's an example. If your taxable income is $100,000, you're in the 22% tax bracket, and then you do a Roth conversion for, say, $50,000, then you will owe federal taxes of $11,000. How did we arrive at that? It's $50,000 times 22% because you executed that Roth conversion at your marginal tax rate, got piled on top of all your other income, got taxed at your marginal rate, which is 22. So when evaluating whether or not to do a Roth conversion, you have to ask yourself if the marginal rate you pay today will be higher or lower than the tax rate you'll pay on those dollars when you distribute them from your IRA somewhere down the road. So that's why I've always said that the single greatest decision on whether to undertake a Roth conversion is whether your tax rate will be higher now or in the future. That's all that really matters. Now, it's extremely important that you not use the effective rate in this scenario because it's going to give you an inaccurate picture of the cost of doing that Roth conversion. It's going to make the tax consequences seem less significant than they really will be. So you may be surprised when you get your tax bill at the end of the year. All right, the second scenario in which we use the marginal tax rate instead of the effective tax rate is when evaluating the benefits of certain deductions. So for example, if your taxable income is $100,000 and you decide to contribute $10,000 to your 401k, at what rate will you experience tax savings on that $10,000 401k contribution? At the 22% rate. That's your highest marginal rate. So in other words, you're shaving money right off the top of your income, the portion that poked up into that highest marginal tax bracket. When you no longer have to pay tax at the highest marginal tax rate, you save money at that rate. So in this case, you will have saved $2,200 on your federal tax bill. Now, the same thing would hold true for any other type of deduction, be it a mortgage deduction or a deduction for state and local taxes, et cetera. The third scenario in which the marginal tax rate comes into play is when we're calculating short-term capital gains. We know that if you sell an investment within a year of having purchased it, you're going to pay short-term capital gains, which is calculated at ordinary income tax rates. And those gains are going to flow into your tax cylinder and be piled right on top of all your other income and be taxed at your highest marginal tax rate. So for example, let's say that you bought an investment that grew at 8% and you sold it before the end of the year. You didn't hold it for a full year. The growth on that investment is going to flow into your tax cylinder and it's going to be taxed at your highest marginal tax rate. That's going to convey the true impact of having made the decision to sell that investment prior to that year anniversary. So if that income flows into your 22% tax bracket, then that 8% growth rate is going to feel more like 6.24%. Now, remember, we're trying to accurately measure the impact of making a given financial decision. So this particular scenario can help you appreciate the value of investing in, for example, a Roth IRA. So the higher your marginal income tax rate, for example, the greater the benefit of a Roth IRA. If your marginal tax rate is 37%, for example, then your after-tax rate is 5.04%. So the higher, as a general rule, the higher your federal marginal tax rate, the more it makes sense to invest in a Roth IRA versus a taxable investment or a brokerage account or what have you. You can also make the case it makes more sense to invest in an LIRP as well. Now, marginal tax rate is not the same as effective tax rate, but in my flagship presentation, which many of you have seen over the years, because I've given it over 1,000 times, I do talk about the history of marginal tax rates. I do this because highest marginal tax rates are usually bellwethers for what all the other lower tax rates are doing. So for example, back in 1960, when the highest marginal tax rate was 89%, the lowest rate was 22%. Contrast that with today, where the highest marginal tax rate is 37%, the lowest tax rate is 10%. So you can see as that highest marginal rate ebbs and flows over time, it has an impact on all of the rates below it. That's why I like to make people aware of what highest marginal tax rates were in the past, because as that ebbs and flows, then your tax rate will likely ebb and flow as well, wherever you fall in that continuum. Okay, let's talk about effective tax rates. There are fewer scenarios in which we would use effective tax rates. It's primarily used in financial planning software when you're trying to calculate the actual tax you'll be paying in a given year in retirement. This ends up being the weighted average of all the tax brackets your income moves through as you progress up that graduated cylinder. So for example, let's say you have to take out $100,000 out of your IRA in a given year in retirement. You would apply an effective tax rate, or the average weighted tax rate you'll be paying on that $100,000. So if your effective tax rate is 20%, then the software will show you as having $80,000 of net spendable income. That's net spendable income after tax. Very important that you not use marginal tax rates in the scenario because it's going to show you taking out more money than you really need. And it's also going to show you running out of money before you are actually going to be running out of money. Now, in financial planning software, you're going to have to calculate the state tax as well. And that gets thrown right on top of what your effective federal tax rate is. So you might have an effective federal tax rate of 17%, throw in another 7% on top of that. And that's going to get you to a combined state and federal effective rate of 24%. Now, here's a quick and dirty way to figure out what your effective tax rate is. And this generally works pretty well. Not always, but it's going to get you pretty close. So you take your marginal tax rate and you subtract 7. That's going to get you pretty close to your effective rate. So if your marginal tax rate is 24, subtract 7, and 17% will be pretty close to your effective federal tax rate. Now, if you are in a state where your state tax rate is 7%, then you get to add that right back on top of your effective federal tax rate, and that's going to get you right back up to 24%. So in some states where your state tax is 7%, then your effective tax rate plus state and your federal marginal tax rate are going to be pretty close to the same number. All right, mistakes people make. Now, people make mistakes when deciding between the effective and the marginal rate, and it usually happens with the Roth conversion. They'll say, hey, I don't mind doing a Roth conversion because it's only going to move the needle on my effective tax rate just a little bit. Maybe it's only 2%. No big deal. What's an extra 2% in the big scheme of things? Well, that's not really how it works. You don't use the effective tax rate to determine whether you should do a Roth conversion in a given year. The Roth conversion calculus happens at your highest marginal tax bracket, highest marginal rate, not at your effective rate. And I see that all the time. People say, I should do a Roth conversion because it's only going to move the needle on my effective tax rate 2%. That has nothing to do with the calculation that you're doing. It's not going to be the rate at which you pay taxes. So if your effective tax rate is 15%, you do a Roth conversion that pushes you up to the 17%, you are not going to be paying taxes on that Roth conversion at 17%. It's going to happen at your highest marginal tax rate, and that could be much higher. It could be, at the 24% tax bracket. So we got to be very careful that we are using the effective tax rate in the right circumstances and the marginal tax rate in the rest of the circumstances. And by and large, it's going to be the marginal tax rate that we will be using when performing all of these various financial calculations, determining whether a given financial decision makes sense. Okay, that's the show for today, folks. Appreciate you tuning in. Once again, if you are looking for someone to help you navigate all these issues, head over to davidmcknight.com. Happy to connect you with a member of our elite POZ advisor group. If you are a financial advisor looking to assimilate these concepts into your practice, head over to powerzero.com, opt into our free 3-part video series. Happy to connect with you. Once again, would appreciate a follow on Twitter. It's @McKnight&Co, @McKnight&Co. If you haven't had a chance to watch our documentary, please do so. It's The Power of Zero. The Tax Train is coming. As always, would appreciate a subscribe to this podcast. You can subscribe wherever you listen to podcasts, and you will get an email every week letting you know that the podcast has been published. As always, I appreciate you tuning in, and we look forward to chatting with you same time next week.